Welcome to the Finance Podcast. The topic of this episode, replicating hedge fund success, capturing returns without the drawbacks, with Miguel Tiedra from BCV.
Okay, well, thanks very much, Adrian. Good afternoon, everyone. My name is, as is just said, I'm Miguel Tiedra. I'm heading the Alternative Investment team and Quant team at BCV. And today, I'm not sure the title is mine, but we're going to talk about replicating hedge fund success, capturing return without the drawbacks. So basically, what we are going to do is to talk about hedge fund replication or ETF of hedge funds. But maybe before doing that, I suggest that we look a bit back into the past and see how assets have performed. You probably know this already. But as many people say, usually you shouldn't do that because past performance is no guarantee for future return. So what we need to do is looking forward. And by doing this, we will realize that maybe we have an issue with equities and bonds. And if this is the case, if you agree with me, then what else? And so we will move into hedge fund investing. But obviously, hedge funds come with drawbacks. And the answer a way to address that situation is maybe to look at a hedge fund replicator or ETFs, hedge fund ETFs. So if we start first, looking at the returns, I said, okay, what's success? Because we said capturing hedge fund success. And I know that many people are a bit, let's say, in doubt when we are talking about hedge funds because what they think is, okay, that's the MSCI World, that's the SPI, the Swiss Performance Index, and this is hedge funds, expressed in Swiss francs. So over the last 10 years. So I agree with you, that's not that exciting. But if we take into the equation the bonds were not really exciting neither. I mean, if you look at, here I've plotted three bond indices. The only one that is positive is the Swiss bond index, but for the European index or the US index, they are both negatives. So what I'm trying to say is obviously hedge funds were not performing maybe as expected, but what is also worth to know is that equities have been really on fire for the last 10 years. If we shorten a bit the period and we look over the last 5 years, the picture is a bit better for hedge funds. So again, MSCI World, Swiss Performance Index, equities, Swiss equities, and HFRI Fund of Fund, which is the index on fund of hedge funds. That's okay. I mean, still lagging, but that's what you should expect from hedge funds. The goal is not to outperform equities, obviously, but to protect capital. But if you look again to the bond markets, over the last 5 years, they were all negative. So be it the Swiss bonds or the European ones or the US ones. So what I'm showing this is because maybe just to put things into perspective and maybe change a bit the mindset. Everyone tends to believe that, okay, hedge funds were really not performing. Actually, they performed a bit, not much, but the picture is even worse for the bond markets. Please feel free to interrupt if you want to raise a question or yes?
Just a question for the MSCI World.
Yeah.
Expressed in Swiss franc as well?
That's a good question. I don't think so. Okay. So the picture would be a bit lower, but still outperforming. But I don't think so.
Yeah. Another question. The HFRI Fund of Funds.
Yes.
Is not really representative of what the best hedge funds have done.
No, but
Probably the lowest.
That's an argument that's an argument I'm always hearing. To be honest, the same applies for the equity market. I don't think the MSCI World or the SPI is among are representative of the best Magnificent Seven, let's put it that way. That's a way to look at it. And having said that, honestly, HFRI Fund of Fund, many people are criticizing it for. It's obviously an average, which is also the case for the equity indices. But beating an average is not easy. And the same for the equities, the same for hedge funds. Many hedge fund providers do say, okay, HFRI, yes, that's the fund of fund. If you look at their figures, that's very difficult. That's an index that is not that easy to beat. you can beat it if you, because it's an average of many different hedge funds. It's easy to beat this index if you just buy HFRI equity long short, because you have a lot of beta in this. But if you have something that is diversified, not that easy. But I take the point. Obviously, if you are capable of selecting the best manager, you shouldn't go for this, but the same for the ETFs on equities. The picture, because I think we should look into the future. And so this is a graph. I don't want to take too much time. That's the valuation for the US equities. So this is simply the CAPE index. So basically what we are showing here is the average PE according to the Schiller index, the PE level for the US market. So you can see here 36. We are not at max, but still not cheap. Probably the average is around, I don't know, around the 20s or 22. And here we are at 36. So what I want to stress here is that the equity market is not cheap, that's for sure. Is it expensive? Maybe a bit less so today, but still. If we look into at the bonds here, this is something we've done. This is an index that doesn't exist. This is the Swiss Treasury index. That's something we rebuilt. So this is simply and here in blue, this is the rates on Swiss bonds, Swiss treasuries. What you can see is this index has been up most of the time, and that's not the goal of this graph to show that, but it is. What is interesting is when, on average, the Swiss rates were around between 4 to 5, probably, historically speaking. More recently, over the last 30 years, they have been decreasing, hence the good performance of the Swiss bond index. But what is interesting is, even though during periods where rates were rising, the index was rising simply because the carry was positive, because you had a coupon that was good enough in order to offset the rate increase. The issue we have now is at this level of rates, right now, I've checked this morning, we are around 40 basis points. Inflation is around 30 basis points. So buying a 10-year treasury or 10-year conf in Switzerland, you are almost, you are slightly earning more than the inflation, not much. So my point is simply that when you have very low rates, the bonds tend to not diversify when something happens. And that's actually what happened during 2022, where we had this really this issue. Over the last 15 years, basically, over the last 10 years, bonds do provide diversification when the equity market decrease. And that has been the case most of the time. But in 2022, we had a low rate environment and rates rising due to inflation. Bonds as well as equity markets were suffering. So the point is, yes, bonds tend to diversify your portfolio, maybe not as much as it was the case in the past. And honestly, the risk-reward, again, when you have rates at this level, you can go maybe a bit lower, but the asymmetry is quite huge. So what can you do? What type of asset you could put into your portfolio? I don't want to review all the assets that are tail hedges or diversifying your portfolio. I mean, some people might say, okay, you should invest in, option strategies where you protect your portfolio. Yes, but the carry is enormous. Maybe gold is one way to do. What we've heard very recently, is that private equity markets are the way to go because they are not correlated. My point is private equity are nothing else than equities that are not listed, and this type it's not a new asset class. This is simply equities that are levered and correlated. So this is a table I've taken from Cliffwater and AQR, and that's fine if you have something that does better than the equity market. Why not going for the private equity? But here again, if you take this table is interesting because what it's plot here is basically the return the 10 biggest endowments in the US have extracted from their private equity portfolio. So here, private equity portfolio or their portfolios in general. So you have here, for the period of between 2010 and 2020, the US stock market for these guys, the 10 largest endowment, did return 13% on average, 13% annualized return, whereas the private equity did 13%. So the point here again is, obviously, there are very good managers that did better than that, but if you are able to select all the best managers doing private equity, that's fine. You would have earned 17%, 15% for the stock market. But again, this is not easy. And if we take an horizon that is longer than that, 2010, 2023, 13% for stocks, private equity, 14%. So you see, private equity, equities, on average, do the same, but be careful, because as we know, I mean, private equity are not liquid. You don't have prices that are reported every day, so hence the lower volatility. So I say, okay, no, private equity is probably not a good way to diversify your portfolio. I'm not saying private equity is not interesting, but that's not this is not something that will help you during market crisis. Maybe you won't realize that the private equities are going down, but they are. So hedge funds. So that's here we are moving to US dollar because that's easier, but equity market, again, MSCI World, global bond market, hedge funds. Okay, that's a graph we know. Maybe a good way to show that hedge funds, even the average ones, are providing investors with diversification is to look at the market downturns. So basically, if you took 2008, minus 54% for the equity market, minus 22 for the bonds, for the hedge funds. If we look more recently, maybe the COVID crisis, minus 21 versus minus 9, and Ukraine, minus 25, minus 7. So these are figures that are real, and these are for fund of hedge funds. So not the best hedge funds in the world, the average fund of hedge funds. But you see here, you have definitely the correlation. So the case might be made that hedge funds do provide some certain level of diversification, and having hedge funds on the top of your maybe bond allocation do make sense, because here we've taken the worst drawdowns, not for equities this time, but for the bond markets. And you see basically there is no relationship between the drawdowns in bonds, so hence when the rates are going up, and hedge fund returns. Hedge fund returns do not take duration risk, so they are not absolutely not sensitive to what's happening into the bond market. So again, interesting in terms of diversification. Obviously, hedge fund drawbacks, there are many. The people are very often mentioning the level of fees, the liquidity, the transparency, and I would say that is true most of the time, even though the situation in terms of fees has improved a bit, not for every hedge funds. And then if you invest in hedge funds, single manager hedge funds, obviously you need to have a certain amount of money in order to enter these guys. And if something happens, if you may have a hedge fund blow up, and you're going to lose your money when you invest in a hedge fund that blows up, obviously. Fund of funds do address certain issues, the minimum investments required, the single manager hedge fund risk, because the fund of fund is diversified, but you still have a higher level of fees because you have an additional layer of fees, actually. Liquidity is monthly to quarterly, and you don't have full transparency. And here comes the hedge fund replication strategies. And obviously, as you can imagine, these guys, what they try to do is to replicate hedge fund returns, the average hedge fund return again, but they don't have these drawbacks. Actually, they have one. These guys don't know how to replicate alpha, but the fees, the transparency, the liquidity, everything is better. And the reason is very simple. This is simply because these hedge fund replicating strategies do not invest in hedge funds. So they try to do it, but without investing in hedge funds. So I'm going to show you very briefly how this is possible, and I'll show you the comparison between hedge fund replicating strategies and hedge fund returns. So hedge fund replication, very rapidly. How can you replicate an hedge fund return without investing in hedge funds? And most of the time people say, okay, how could a quantitative strategy extract alpha and replicate hedge fund returns? honestly, when you do hedge fund replication, you will not be able to replicate the alpha of the manager. So basically, the ability of the manager to time the market, to select the good stocks or the good credit. But what you can do is, we know very well now that when you invest in a hedge fund, these guys are taking exposure to the traditional markets. These guys are taking exposure to risk premia. So risk premia is or risk premia or risk factor, basically, or alternative beta. These are simply value when you invest in the cheapest stocks and you sell the most expensive one, you are doing value. When you invest in the stock that have performed well recently and sell short the one that have not performed well, you invest in momentum. And we know this when you invest in high yielding currencies, you do some carry. And we know that the hedge fund manager do a lot of this. And actually, when you do a performance attribution of an hedge fund manager, actually a lot of performance comes from the risk premia and the traditional market, and the alpha is rather tiny, honestly. And if we do agree about this edge performance breakdown, for a quantitative model, that's very easy to replicate traditional beta or alternative beta. And I'm going to show you how. So, as I said, hedge fund replication is about replicating the hedge fund returns, and it's based on quantitative techniques. And the easiest one, and I don't want to go too much into the detail because we don't have enough time, the easiest way to guess what type of exposure a manager has is to run a regression analysis. This is a quant methodology that will try to assess how much of a certain factor or certain market the manager is exposed to. So that's the easiest way. And it works, but not perfectly, but because obviously you are looking into the past, and then you are dependent on the history of that you can look at. And what is a bit annoying when you are trying to replicate hedge fund returns is that when you buy a hedge fund manager, you want the hedge fund manager to be very active, to adjust his portfolio very actively. And so basically running a regression analysis, you need this regression analysis to be dynamic in order to take into account that a long-short equity manager, for instance, when the market is up, he will increase his exposure. When the market is down, he will decrease it. And so you need to have a model that is dynamic enough in order to capture this. And so that's what is expressed here. That's the typical formula for how you try to replicate or how to run a regression, if you want. But the problem is, and the beta basically are the weight your model should try to forecast. How much of S&P 500 should I have into my portfolio? How much of bonds or currencies or momentum or whatever? This is what you should try to forecast. The problem is, as I said, is if you take let's say the HFRI Fund of Fund Index and take all the historical track record and you run the formula on it, it will give you weight or exposure for every factor that you have introduced into your portfolio. The issue is if you take the HFRI Fund of Fund for the last 30 years, as I showed you, you're going to have one beta that is working, or one exposure that is working for the entire period. That's an issue. What you want is, what you are really trying to have is a model that is dynamic, where the betas move very quickly. I don't have enough time for this one. But what we've done, and one way to approach this issue is to use a quantitative technique that instead of just looking for an entire period, you are using a model that is based on a Kalman filter methodology. So basically, that's a methodology that instead of forecasting once the exposure you need to have into your portfolio, basically the model does forecast every month, and every month it compares its own forecast versus what it should have had in order to be right. So basically, the model, and I really don't want to make things too much complicated, the model is always trying to adjust according to what really happened. And so that's the Kalman filter. Kalman filter is not something that is new. That's not something that is just for finance. That's something that is used in many different fields. But we've been using this for the last 10 years. And Adrian mentioned this at the very beginning. I mean, the genesis of this product dates back, more than 10 years ago. And actually, we had a trainee, a young person doing his master's thesis with us at BCV. And the thesis was about, performance attribution, replicating returns. And actually, the professor she had at the time was getting excited about hedge fund replication. So basically, and as well we did, so basically we partnered with this professor of University of Lausanne, and we developed a technology, a methodology that is put on the top of of the Kalman filter methodology. So basically, we've been able to develop a model that is very reactive and capable of forecasting weights that your portfolio should have in order to replicate hedge fund returns. And then we've been running this model for the last 10 years. So I said, what is difficult for when you deal with hedge fund replication is to have the weights or the betas that are dynamic. And then the question is the factor that you are using. Factor are either market or risk premia. So what type of factors or market, or how many factors or market do you need in order to replicate hedge fund returns? That's the question. And as far as our product is concerned, basically we are claiming that we are capable of replicating hedge fund returns with 11 factors. So basically here you see our model. This is a snapshot of the portfolio actually for end of last month. We have 5 equity factors, so large cap, small cap, US, Europe, Japan, and emerging markets. So equity factors. We have 2 factors or markets. One is on the US Treasuries, one is the Eurobond, 1 credit exposure, 1 commodity, and 2 currencies, Euro and Japanese yen. And what I'm telling you here is with these 11 factors, you see 5 equity markets, 2 fixed income, 1 credit, 1 commodities, and 2 currencies. We are able to replicate the HFRI Fund of Fund Index almost perfectly. So before showing you the results, so when I said hedge funds are dynamic in the way they are moving their exposure, here I have separated the equity factors to the other ones. And what you can see here are the respective weights over time. So everything is real. This is since we've launched the fund. This, for instance, the dotted line here is the exposure to the aggregate exposure to equities. So you see, on average, probably our model has been exposed to 30% in equities. But for instance, February 2020, just right before the COVID, the model was exposed 30%. When we had to rebalance, the model went from 30% to 15%, back up to 40%. Maximum equity exposure the model was guessing was around 55%. And so you see, and the exposure can be long and short, obviously, because hedge fund can be long and short. So for instance, US large cap, for more than a year now, we've been short US large cap in order to replicate hedge fund returns. And the largest exposure the model is suggesting is the US small caps. If you look on the other asset classes, so the model, again, is long and short. You see, I mean, it's rather dynamic, month over month. It moves quite a bit. Right now, the model is short commodities. It's long credit. And short euro, and should be U.S. bonds. Let me see in blue and long U.S. bonds. What is interesting, just for this graph, is since we've launched the product, the model has been short U.S. bonds for almost its entire life up until the COVID crisis. And that's interesting because obviously it was wrong, but guess what? Hedge funds were short US Treasuries, and probably most of us in the room were expecting the yields to go up instead of go down. But so the model is trying to do not outperform the hedge fund market, but trying to replicate what hedge funds are doing. And just to conclude, so this is the track record of the hedge fund replicator that we are managing in green. In gray, this is the HFRI fund of fund, and in light blue, the HFRX. And you can see, actually, without knowing what the hedge funds are doing, a model with 11 factors can replicate pretty well, I would say, the performance of hedge funds. So you see, for this period over the last 10 years, the fund of fund index was up 50%. Our product was up 48%. Annualized return, we are talking 3.9 versus 3.7. And you see, well, obviously the beta is close to 1. And month over month, it's not perfect. But it's a product that is interesting because it invests in futures mostly, a bit of a few swaps, so super liquid, and we can deliver the average hedge fund performance. You said this is average, not the best ones, but still, I mean, 2022, the fund of hedge fund index was down 5.3. We were down 5.1. You see, very close, and it helps. I mean, as a reminder, for the same period, equity markets were down 20%, and bonds almost the same. So yeah, I think that was really the key messages. There are other ways. What I didn't say, there are other ways to do hedge fund replication. You can do. We've taken the decision to do a multi-factor analysis, and you've seen that the portfolio is rather simple, only 11 lines, only futures mostly. But you can do it by replicating what hedge funds are doing. You can have a portfolio that is much more complicated. But what I find very interesting is with a very basic portfolio, very simple portfolio, you can replicate pretty well what hedge funds are doing with a full transparency, low fees, and a daily liquidity. So, yes?
Why correlation is not
shown? We could do a correlation. There is no particular reason. I don't know. Sorry?
The correlation is shown.
Sorry. You're right. Yeah, with the fund of fund, 0.9. 90%, sorry. Yeah. I didn't saw it. Yeah. And HFRI, we are showing, honestly, again, I think the way why the people do see hedge funds negatively also is because maybe many people are using the HFRX index, which is an index that is daily and is supposed to be replicable. But honestly, this index is not very good, as you can see. And but the benefit of this index is it's calculated daily. But as far as we are concerned, the goal is really to do the same type of performance as fund of hedge funds. And I think we deliver it. And there are periods where when we have more volatility, obviously, probably this is more difficult. Our product is traded daily. We are using daily product. Fund of funds on this index is calculated on a monthly basis. So that's why if you compare volatility, for instance, the fund of hedge fund index has a volatility of 4.8 versus our product 4.9. I think maybe there is a bit of smoothing into the HFRI fund of fund index. So this year, year to date, 1.5. And last year, we did 8%, 8.2. Yeah.
Could you tell us something about the counterparty risk for the swaps?
Okay, yeah. So the portfolio, as I said, is very simple. There is no counterpart. A big issue with hedge funds is the people are scared of having a hedge fund blow up. Here it won't happen, and we invest on. We have it's all future except for the credit and commodities indices. Credit, because basically the future on the high yield credit in the US is not good enough, not liquid enough. And commodities, the reason why we've made a swap with 2 different investment banks, it's simply because this product is UCITS, and because it's UCITS, you cannot have a certain level of concentration. And if you take the future on commodities, they have too much exposure to energy. So that's why using this swap on the BCOM, BCOM doesn't have any future. We are able to have an index that is diversified, and thanks to that, we can have a product that is UCITS, basically. So very simple. So counterparty risk, with the future, you have a clearinghouse, so the risk is almost non-existent. And for the swaps, you have a counterparty risk, so that's why we have 2 different counterparties on commodities. But you have to be aware that, we are netting the P&L every day, and every time we have a positive P&L, we ask the counterparty to send it to us. So positive P&L means $250,000 US dollar. Compared to the assets under management, that's almost nothing. So no real risk in terms of counterparties. Really the risk you are taking here is if the hedge fund do not perform. Because if hedge funds are negative for a very long time, we are going to be negative. And if they are positive, we are going to be positive. So that's really the biggest risk. But being daily, you can change your mind every day if you want. Yes? Yes, that's a good question.
Your max net, max.
There is no max. That's an excellent question. You know that when you look at the broker or prime brokers, you know that hedge funds on aggregate, according to the latest survey, hedge funds are levered 2.5 times, but that's gross exposure. And as far as we are concerned, the model tries to replicate the performance. So basically what really matters is net. So to answer your question, there is no limit on the leverage, because the model do not constrain leverage. But if you had here 25% and all this, we almost never cross more than 100% net exposure. So we are never levered. And it makes sense because if you take, for instance, a long-short equity manager, is long 150, short 100, so 250 gross, but net 50%. And so that's why we don't need to be levered in order to post the same type of returns. Yes?
Have you tried replicating single successful hedge funds?
Single ones, no, but I can tell you the answer is that we won't be as good as this. We are good at this because the aggregated manager, on average, their exposure moves slowly, so you can cope with these dynamic betas. Otherwise, it's difficult. And honestly, there are strategies that are more difficult to replicate. It's going to be very easy for us to replicate the HFRI equity hedge index, for sure. Trend following index, not using that type, multi-factor analysis, no, but using moving average, fast, easy. Then pure arbitrage strategies, multi-factor analysis won't work well. Or event-driven. Yeah, or event-driven, yes, yeah. Yes, exactly. So that's what I said at the very beginning. We cannot do alpha or even liquidity premium. I'm not sure it's an alpha, but even here it's difficult to extract it. Or we should include short selling stuff, but we don't do that. Yeah.
Can AI help you to futures for different processes?
Sorry?
AI, can it help you, or it's not valid?
I'm not sure, honestly. We are working a lot on using AI for the different products. On this one, I don't think so. What I didn't mention is, I mentioned very briefly that we are working with the University of Lausanne. We have an advisory committee. Every 6 months, we review the factors. Are we using the good factors? Honestly, where we could be in trouble if, for instance, hedge fund managers start to invest in an asset class that is not correlated to the ones we have in the portfolio. I could imagine Bitcoin, but whatever. In this particular case, we would need to add a factor. And but again, in the first place, if the people try to now macro maybe have 5 to 10% allocated to Bitcoin, the model will probably use the small and mid caps or something that is volatile in order to do the same type of returns.
Could you invest in gold in this strategy or not?
We don't. We have gold within the commodity index, but that's all.
Okay,
Yeah.
Physical,
Yeah.
like minings or?
No. It's really the instruments we have are always the same. These are all the instruments: S&P 500, Russell 2000, Eurostock, Nikkei, MSCI Emerging, Bund, and that's it. That's the. And over time, it was too quick. But you will realize that we have more, when we've launched, we have less factors, and we have added a few of them because we had more points, basically, and doesn't make a huge difference, but maybe on month-to-month basis, we added the Nikkei, for instance, the euro and Japanese yen. In the past, we only had the DXY, the US dollar basket, stuff like that. Well, we've been working. So now this product is live since 2014. So it's been live for 10 years, more than 10 years, and we've been working on this product maybe 3 years before launching it. And since we've launched it, we have, as I just mentioned, added a few factors. We have changed a bit more on the operational side, because when we were at the very beginning, we were too small in order to invest in to have swaps with investment banks. We've been trying a lot of stuff. Every 6 months, we have this advisory committee. We do some research. As you may have noticed, here we have factors only on markets, but we've been also running the program on risk premia factors. And then we do research all the time, and but big changes haven't really happened, honestly. Yes, sorry.
Have you ever tried to replicate other asset classes, such as infrastructure, private equity, or any other?
Infrastructure, no. Private equity, yes. Guess what? My issue is we can do it. Private equity, honestly, I can replicate it very well. The only thing is, if I replicate it with listed instruments, you got to be very scared about the volatility.
The wall is moving, right?
Yeah, no, but the volatility is crazy. You can have as much as 80% volatility. But at the end, the results and the returns are really close to private equities. We are still working, we have this on the back of our heads, because I think that's interesting. And honestly, private equity, as I mentioned, this is equity with certain bias, value, leverage, you know them. And but for the time being, we don't know how to minimize the drawdowns, honestly. Or we do a replicator, but that is quarterly. But then, what's the goal for the people? Yeah.
Perfect, thanks.
Have you analyzed whether there's alpha in the timing of these betas? So are the hedge funds good at timing the betas that you replicate, or are they just random?
Well, it's difficult to say. There are times where we do better than the index that we are replicating. So, but
what I meant is, when you, for example, take an average exposure to all of your betas,
yeah.
Is that index more successful than what you're replicating? So maybe these fund of funds are not even good at timing the betas; they're just arbitrarily running positions. Yeah,
but fund of funds is an aggregation of talented managers. Yeah. So these guys should probably time a bit the market. No, I don't think we have alphas. No, it's really not the way we look at it. And when I don't think we have it here. No, I don't think we have it anymore. there were a period where we were massively outperforming the fund of fund index, and it was simply because fund of funds were an equity long-short manager were investing massively into healthcare, and we don't have any factor that is specifically by sector, just the markets. So that's why we were not suffering as much as the fund of funds, for instance. But I don't think there is alpha, no. And honestly, I don't think there is a lot of alpha on aggregate when you look at hedge fund managers. And let's put it that way. There is alpha, that's for sure. There are many academic studies that shows that there is alpha, but because of the fees, the alpha is shrinking. Okay, I think. Well, thank you very much again. Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.